I'm Caroline Hyde at Bloomberg's San Francisco studio.
Welcome in New York, together back in San Francisco. I'm Ed Ludlow. This is Bloomberg Technology, and how nice it is to have you here. So many headlines to pass over, many of them market moving, when there's some feel good right now around technology despite layoffs, despite everything that's going on.
And it is centric to being in San Francisco this week with all the earnings to come. First and foremost, we talk about valuations here in Silicon Valley. Microsoft's $10 billion bet on OpenAI is just the start of the artificial intelligence revolution. It's what Microsoft's chief product officer is pitching as, quote, the defining technology of our time.
And more local to us, Elliott's multi-billion-dollar stake in Salesforce comes as a wave of activist investors push companies to act more on behalf of their shareholders.
And we now know what Apple's mixed reality headset is capable of as the company explores a new approach to eye and hand tracking controls. But first, let's do it. Let's get to these markets because it was another buoyant day. Ed, you called it. It's the moon music turning once again into the green. The S&P 500, the NASDAQ both up more than 2% for the NASDAQ. So big tech on deck as we know the earnings are to come and people are feeling good about it. We're seeing in particular stocks related to chips getting a real bid. We're up more than 5% on the Philadelphia Semiconductor Index. Why? Barclays had a note out really upgrading some of the views on Qualcomm, some of the other key chip makers, so that helped fuse some interest in these particular stocks. And I'm looking at your 60-40 working for you once again as equities push higher, bonds are actually selling off. Maybe they're still a little bit more cautious about what the Federal Reserve has in store for inflation. Remember, we go into a silent period for the Federal Reserve ahead of their next meeting come January 31st and the day after, when we hear where rates will go. Most of the market hoping it will just be a quarter of a point rate rise. Now let's flick it on and have a look at what else has been getting a bid up, and some of those more, well, risk on kind of trades are still working for you. Now, over the course of 2 days, remember, Bitcoin never sleeps. It doesn't sleep for anyone, Ed. And crypto was trading on Sunday, and it was down more than 2%. We managed to offset most of that, and we're only off by about 9% over the last couple of days. But today was another day of green for crypto. Bitcoin on the upside.
Look, we're 3 weeks into the year. There's still some feel-good around some of the more downtrodden corners of the market, speculative, higher multiple tech. But the news cycle continues to be a driver. You think about the specific names that I'm looking at, starting with Microsoft. I thought it was really interesting when we got that confirmation that Microsoft is investing multiple billions of dollars into OpenAI. Bloomberg had reported, according to a source, it was in the $10 billion range. We saw a pop in the stock in early trading, actually a more muted response, one all told by the end of Monday's session, up a percentage point. And then there's this idea that from worst to first, as one person put it on the Bloomberg terminal, some of the most downtrodden stocks, and particularly high multiple EV names where valuations have come down to catching a bid, both Rivian and Lucid, the two top performers on the NASDAQ 100 on a percentage change basis, really getting some momentum as we go into that earnings season where speculative tech hasn't had much love. Well, maybe we'll now. And Salesforce, it's probably the story of the day, right? Elliott Investment Management, according to a source, has built a multi-billion-dollar stake. What was so surprising for me, Caro, is the lack of surprise around this. Very few sell-side notes out, but those that are saying, actually, given the kind of downward long trend on this stock, we're not surprised. I'm looking at the forward 12-month PE of Salesforce. It's down near financial crisis level. Valuations have come down. It's relatively cheap. But what Elliott seems to be pushing for is shareholder returns and a focus on profit.
Yeah, well, aren't they all? Focus on profit is going to be the watchword throughout the week, the month, the year. But Ed was just discussing how the focus on Elliott Investment Management has had us all eyes on the tower that is here in San Francisco, of course. What is Mark Benioff? Where is his focus now? And what does the activist stake really mean for his business? Swooping in, of course, after layoffs, after deep stock plunge at the enterprise software giant, Bloomberg's Liana Baker is more over in New York. Liana, as I sit here in San Francisco and I think of initially the worry many had for Mark Benioff, perhaps as we'd seen some of the other executives shed away, many had thought maybe that meant he was going to be doing more deal making, spending more. But does an investor like Elliott mean that's off the cards?
At this point, we don't know exactly what Elliott is pushing for, but we have seen their public statement that was pretty complimentary of Mark Benioff, so it doesn't look like it'll be a nasty fight. That said, Elliott Management has taken on so many big tech companies over time that have made so many changes, so there could really be a range of things that they would like. I think ultimately they want the stock to go up and that they believe there's probably ways for shareholder value to be improved.
You know, Liana, this time around Salesforce, Elliott's name crosses the Bloomberg terminal monthly, it seems to me, you know, the cadence of their investments. What is their track record on working with companies? Because you said, you read the statement from the company, deep respect for Mark Benioff was the word they used. It doesn't seem hostile. It seems they want to work with Mr. Benioff over at Salesforce Tower.
And one of the reasons they might be wanting to work in a friendly manner with the company is that I've been joking with sources that Salesforce is now a hedge fund hotel. There's, first there was Starboard, now there's Elliott, Inclusive Capital, Jeff Ubben's firm. He used to be a Value Act is in there, and then there's a mystery activist that we're trying to figure out. CNBC, has reported on that. So there might be a sense that maybe Elliott's the white knight activist to work with. In 2019, eBay fell in the crosshairs of Elliott and also Starboard, and they gave them both board seats. So that's another example that we're kind of looking back in history to see what could happen. Here at this point, we don't know if Salesforce is willing to offer those board seats, but Jesse Cohen, who is the one leading the investment for Elliott Management, he sat on some pretty big boards.
And Liana, just put it into perspective. 2022, the last quarter, we saw so many more activist stakes really being built globally, worldwide. How many offenses are there? I can already think of what Disney's out there, Intel, what other companies?
So you nailed it with Disney. That's kind of the big one that the whole activist community is watching, because that looks like it's headed to an actual shareholder vote at some point. Elliott doesn't usually get to that shareholder vote, so I'd be surprised if that's where Salesforce is headed. But right now we're entering this, what we call proxy season. These nomination windows are starting to open at various companies. So we're seeing investors come in and say, hey, we want to nominate shareholders. Salesforce's window is coming up in February. We'll be watching that really closely.
All right, Bloomberg's Liana Baker, who leads our deals coverage, investor coverage. Thank you so much. Caroline, welcome to San Francisco. If you jump in a cab, okay, you go downtown.
Uber or a Lyft?
Whatever, no preference, but you'll see the Salesforce Tower.
Yeah.
And this is what jumped out at me on the Bloomberg terminal earlier, this single chart about Salesforce's marketing spend as a percentage of its sales. And you start to realize what it is that activist investors might be getting at. They're almost at 50%, right, of their sales spend being on marketing, which is kind of mind-blowing a little bit, right? But then they have potential. This is a software company, margins.
It also, though, that spend is largely what, on Dreamforce? I think the last time, who was it, Lenny Kravitz was performing there. These things don't come to... Basically, it's a massive music festival. It does a lot for the San Francisco ecosystem as well, those sorts of events. They bring people to gatherings, whichever city that they're really taking on the road to. The marketing spend is about being in people and in person and sharing ideas, but they're probably going to want him to pull back on that a little bit.
And this is a company that has had to pull off on the layoffs front, in pausing hiring in other areas, and where M&A has been just absolutely rife. The other big story we're watching here out on the West Coast is, of course, Microsoft and OpenAI, a reported $10 billion investment set over a number of years, which OpenAI and Microsoft have now confirmed, sort of, in a blog. The company saying Microsoft will invest multiple billions of dollars. Remember, this is a company that amassed more than 1 million users just within days of launch back in November. And we've already started the debate. Where does this all fit in with Microsoft's strategy? Where does it fit in our lives? The use of ChatGPT and other AI tools, a fascinating one.
And also, how does this help Microsoft gain market share from the likes of AWS? Now, we know that Amazon is the power player when it comes to the cloud provision overall. The fact that Microsoft wants to intertwine OpenAI into really every part of Azure, the business, it wants to set itself apart as a cloud offering. And OpenAI is such a clever way to do it. What's so interesting, of course, is that OpenAI, once upon a time, was a not-for-profit. Now it's a capped profit company. So this deal, this $10 billion that's being invested, it's kind of awkwardly done, isn't it? Because you're kind of it's offering in kind. Basically, OpenAI is able to use the firepower of Microsoft's own cloud provision, right?
So it's a really significant investment from Microsoft 7 days after they have laid off 10,000 staff. But the closed profit model is where basically any money that OpenAI makes, which is by licensing the tools to software developers, they put back straight into the development because they still feel like it's in the nascent stages.
After they've paid investors, after they've paid their dues, and after they've paid their own employees, right?
Yeah, but I mean, we've been trying to identify what is the next big company for the next decade, the next 20 years. There's a lot of debate whether actually OpenAI is it, and the emphasis of them in the news cycle is amazing. And you're right, Microsoft are already implementing this on Azure Cloud for customers. You can use ChatGPT or even DALL-E on the imaging side. So it's out there in the real world. You and I have played with it to a lesser extent, here on the show. But Interesting.
Don't
a lot of cash.
do math on ChatGPT. That was my learning, my podcast learning over the course of the weekend. Ed, I can't tell you how nice it is back in San Francisco.
Right.
Little known fact that ChatGPT wouldn't tell you about my family. My son's middle name is Francisco. That's how much the city
Because of
means
your
to
time
me.
here?
Yeah.
Well, let's make the most of it while you're here. Despite somewhat difficult news that we have to cover in the show. Because,
it's a very different time from 2016, I've got to tell you.
Well, it is, because coming up, layoffs continue in the world of technology, climbing to 57,000 this month. This is Bloomberg.
We've not been positive on big tech for, I don't know, a year and a half.
We do believe that 2023, there is still some deflation to come out of this market after the exuberance of 2021.
I actually think that the tech sector is one of the few sectors that is really discounting a recession in its outlook.
The longer the macro volatility persists, we do expect early stage and seed to start to see that crunch that the late stage is seeing right now.
There is going to be some amount of normalization of that demand. Quite frankly, we in the tech industry will also have to get efficient, right? It's not about everyone else doing more with less. We will have to do more with less.
That was just some of our recent guests discussing the state of the tech sector. And another week, another day, more headlines, all to do with layoffs.
Yeah.
This Monday, Spotify, 6% of staff, 600. And then just as we were getting ready for the show, Gemini, a second round of 10%.
Yeah.
And it just keeps going.
Unrelenting, really. This, though, again, it's about a CEO trying to own the mistakes made, basically saying his words were, I was too ambitious. They put out a note from Daniel Ek talking about the fact that they, once again, hired too many, but also invested too far, perhaps. And the fact that there are executive changes going on at Spotify, they want to have more efficiency. That is the watchword, I think.
There's a debate of how much emphasis you put on layoffs announced versus layoffs enacted. You know, we have the Challenger Christmas data, and people say, well, those are just announcements. They're not fulfilled. And there are others out there in the market who say, there's bright spots here. And that's why I'm delighted to say we're going to discuss with Spencer Green, managing partner at TSVC, which actually has invested in seed-stage companies over the last 12 years. A good example, you invested in Zoom 2011 before they were even had a product, really, and that was coming out of a financial crisis or downturn. When you see these headlines crossing the Bloomberg terminal time and time again, Spotify, 6% the latest, as somebody who invests in companies that actually may still be trying to hire, what's your reaction?
Well, I mean, nobody roots for a recession, but it's definitely good for the seed stage economy. The seed, I mean, you heard, one of your prior guests talking about a crunch in seed. We see the opposite. We see that brand new company formations are booming, and it's become much easier to hire staff, to hire talent. We had a year ago what I would call a double whammy, that it was hard to hire people, and also these big companies were investing in some of these innovative projects. As they cut their investments, they leave room for competitors, and they put more talent on the street.
Spencer, we're delighted to have you in the studio, Caroline and I, while we're together in San Francisco. It feels like the story is not just playing out here, but the reason you're here is I tweeted over the weekend, hold on, is there anyone that's kind of actively trying to go out there and hire all these people? Because we do hear that, but we're looking for some concrete evidence that it's true. I mean, are you saying to your portfolio companies, hey, now's a great chance to get top talent?
Absolutely, and we have portfolio companies. We have one here in San Francisco called Zoom Transportation that runs electric school bus services for San Francisco and for Oakland and for Los Angeles and so forth. They're hiring. We have a recent company we funded called eBots that does assembly robots for electronics. They're hiring. Angle Health is hiring. Lots of our portfolio companies are hiring.
Yeah.
And a year ago, it was much more difficult for them.
It's interesting, and I suppose in many ways this is why the relentless headlines that we talk about, the tens of thousands being let go at Meta and the like, aren't showing up in the federal data, because many would say anecdotally they're snapped up very quickly. They get great severance and then they move on either to become a talent at Zoom, one of your new ventures, the transport company, or are they becoming entrepreneurs themselves? I'm yet to see any sort of charts on new business formation. Are you starting to hear from these people getting great severance packages. I know they probably want to remain at a company and employed, but if they are let go, are they willing to take on a risk and build something?
You know, it's a huge point, and I think it's definitely fueling a lot of the entrepreneurial activity, because what you have is, you know, as you said, folks who maybe have a little bit of money, they've gotten a severance, they've been doing very well over the last few years working for these larger companies, and in some cases, you know, the Silicon Valley esprit and what's happening in San Francisco has always, I mean, so many people that you meet here, they have another startup going on the side, right?
Hustle.
So there are people who are, and so if you think about like who's going to get laid off, some of these people maybe were not rated as the best employees by their big company employers because they were giving half of their time to the company and half of the time to their startup. So now you say, well, gee, I've got a little extra cash, I've got all my day free to work on my startup. Not a bad situation.
Is there an element that you're seeing this worldwide? Is this very much, where are the talent that you're currently hiring and seeing hiring from? Do people want to remain remote? Are you seeing some of your startups that are SF-based, hiring talent that are being let go in Austin, Miami? Where is this all going on at the moment?
It is much more remote than what it used to be. You know, we've been in, you know, I've been in Silicon Valley since the 1990s, and it was definitely, you know, you'd set up a facility, everybody would come there. You even had, of course, you know, companies like Facebook where they were relocated by their investors to Silicon Valley because the story was, oh yeah, we love you, but you can't do it from where you are. It's not so much a destination for companies. I think a lot of companies are formed here still, and the companies that are formed here have done so much more with remote talent. And some of it's offshore, more of it now is actually onshore, but outside of the area.
The conversation that Caroline keep having is that across the startup curve, the opportunity of 2023 is going to be seed stage, earlier stage investments, and actually it's the growth stage funds keeping their powder dry, even though they raised all that capital over the last 2 years. Is that a fair interpretation of where the industry sits?
Certainly, I think so. I mean, at TSVC, we do seed stage primarily, and we feel like the market's coming to us.
Because they need cash, or?
Well, the market's coming to us in the sense that it's just hard to make money at late stage right now. If you have a company that was overfunded at too high of a valuation a year or two ago, yes, you can do a down round. You can get a better price, but then the employees are not happy, so you lose momentum in the business. So even though you might normalize or rationalize the pricing of the company, that doesn't mean that it's going to take off and be successful. So I would hate to be writing $100 million checks right now. I think it's a difficult time.
What size checks are you writing?
We write $1 million checks into early companies. And you think about something like Zoom, there's a photograph, which I wish I had with us, but a photograph of the Zoom founder, Eric Yuan, 2 engineers in our offices in 2011. That was the company. It was himself and 2 engineers, a PowerPoint deck, right? Fantastic ambitions. Those are the kinds of folks that we're funding right now.
Tweet at us after the show. When you're done, send us a tweet.
Yeah.
And Ginkgo Bioworks and Carter, you haven't been a one-trick pony. TSVC managing partner. He's, of course, Spencer Green. What a joy having him right here in the studio with us. Nice tweeting from you, Ed, to get him on as well. Meanwhile, coming up, Apple's headset. It's going to be controlled by your hands and by your eyes. More details on the mixed reality device next and its price point. There's the Bloomberg. New day, new week, new scoop from one Mark Gurman. Let's talk about new details that are out about the highly anticipated $3,000 mixed reality headset by Apple, of course. It's according to sources which boast an eye and a hand tracking system that could set the technology pretty much apart from rivals, right, Mark? You've got this new story, and just tell us about how this one's going to be different from the other ones on the market.
Yeah, that's exactly right. So this is Apple's next big thing. They've been working on it for north of 7 years at this point. They have well over 1,500 engineers on the project. They're getting ready to unveil it in the next couple months and put it on sale later this year. The factories are going to start churning them out starting at the end of next month in China. But the eye and hand control, right? Some devices on the market right now already can read your eyes and have hand control. But with Apple's device, it's the way they work together that makes it so special. If you remember the touchscreen on the first iPhone, that was a big differentiator. The crown on the watch. For this, it's eye and hand control. So let me give you an example. The way you control the device is you can just look at something, whether you want to launch an app, whether you want to swipe through a list or toggle a setting, right? You look at it, and then you pinch your thumb and your index finger together when you're looking at it to launch it. Just like on a touchscreen, you tap what you want, or on a mouse, you point the cursor toward it and then you click. This is you look and tap your fingers together. So pretty nifty.
I guess the question is, how do we get to a $3,000 price point, right? How does this headset differentiate itself from Meta's Quest? The other real question I have for you is, like, as an iPhone user, I'm thinking about Memoji or Memojis and Animojis, right, where you use the camera to kind of map your face and interact with that technology. Is this the kind of extension of that?
Yes, so in terms of the price point, well, it has 14 cameras, right? You have a bunch of cameras outside. You need cameras that can look forward, you need cameras that can look up, and you need cameras that can look down, right? Down to see what your legs look like and what your body looks like in order to recreate what you look like in virtual reality for that feature you alluded to in FaceTime. There's also cameras and sensors inside the device to be able to read where your eyes are looking at. In addition, there's 2 4K displays, right? You know the 4K TV you have maybe in your living room? Well, there's 2 of them, mini ones, inside of the headset to perform virtual reality. The cameras also, in addition to being sensors to see what everything looks like, it's a way to create augmented reality, right? AR usually uses clear lenses, but in this case, it's going to use cameras to create sort of a fake AR, VR mixed reality effect. It's pretty cool in practice, I'm told. The other interesting thing, to your point, is you're going to be able to replicate a lot of the features of an iPad on here, right? So you'll get Safari, Mail, Maps, Calendar, health tracking even. There's also a feature where you can hook it up to your Mac, and you sort of can control your Mac, and then you can see what your Mac screen looks like in virtual reality while using your keyboard, mouse, and trackpad.
Mark, very briefly, how much is this moving the needle for Apple valuation perspective, from an analyst perspective? Do people ultimately think this is going to be a game changer for them?
So in year 1, they want to sell about 1 million units at $3,000. Right, wow. And I believe that's about $3 billion. So in terms of overall revenue for Apple, it's not going to move the needle in the short term. But long term, this could be a multi-$100 billion market. And Apple, given the layoffs at Meta and the hardware changes at Google and Amazon as well, they seem to have a clear runway for not only VR, but other hardware products in the future.
Right, Bloomberg's Mark Gurman, another day, another big scoop, as Caro said. Now, coming up, the showdown over censorship hits the Supreme Court. This as state laws in Florida and Texas challenge editorial discretion at big social media. More on that next.
Plus, no more access to TikTok at universities in Texas. But what exactly are the cybersecurity risks associated with it? We'll have a discussion next. This is Bloomberg. Welcome back to Bloomberg Technology right here from San Francisco. I'm Caroline Hyde.
And I'm Ed Ludlow, and it is a pleasure to have you back out west, back in the Bay Area. We've got to talk about social media, and we've got to talk about regulation. It's been a big theme in the show for a number of days now. The federal government and several states have raised cybersecurity concerns, as you know, Caro, around Chinese-owned TikTok. And as we reported last week, dozens of US schools and US universities have moved to ban the app from campuses, hoping to prevent it from spying on students, asserting the Chinese government could access the private information of its users. Let's bring in Mickey Boland to talk about the potential risks associated with the app. She's global cybersecurity architect and security evangelist over at Checkpoint Software Technologies, which is a cybersecurity solutions provider. I mean, you heard the backstory. Caroline and I have been trying to make sense of this for a number of days now. Campuses move to remove the ability to access TikTok while on campus through the Wi-Fi network. What we're hearing from the users is they don't understand the risk that is being warned about here. Is there a risk?
Yes. First, I want to say thank you so much for having me. And Checkpoint, we believe that everyone deserves the best cybersecurity. So I will say this, for end users that are unsuspecting or really don't understand the risk, yes, there is risk. And this is why we are seeing organizations come together. So agencies, enterprise, like nonprofits, for actually doing a joint responsibility for risk, right? So we need to approach risk as that we have privacy and we have security. We have privacy for data, for protected data, for privacy in end user data endpoints, also for corporate assets, we also have to protect our network. So people are riding the networks to get to these applications, and our networks are vulnerable to attack by malicious actors and malicious spread of malware. And then we have corporate assets and university assets in this case to protect. So it is a joint responsibility, and we do need to help students understand the risk and really educate everyone.
Mickey, going back to basics, the argument is that ultimately personnel in mainland China might be able to access the personal data of TikTok users in the United States. The proposed solution from TikTok is to house the data of US users on Oracle servers based here in the United States. Is that an acceptable mitigation of risk for industry professionals like yourself?
I think I hate to speculate about that, but I will tell you that our Checkpoint research, we actually did extensive testing. We were super curious back in 2020 about was TikTok, were they delivering consistent policy and security, privacy and security rather, and we did find several vulnerabilities. Our research team found cross-site scripting for their ads. We actually found a way to kind of circumvent registration using a mobile device and use SMS, spoofing for registration. There was API vulnerability. So I guess ultimately what I'm saying is we need to demand of organizations that are offering social media applications and other applications primarily for mobile devices that they actually have a consistent security and privacy policy that we can actually trust.
Mickey, compare TikTok to other virally growing social media companies of old. How many vulnerabilities does it have vis-a-vis competitors?
Across the board, I'd refer to our research team for that. I think that TikTok, to their to justice to TikTok, they actually did fix the vulnerabilities that Checkpoint research team presented to them. And indeed, we worked together in 2021 to help them pen test these vulnerabilities. I think that just ultimately what we need to understand is from an attack surface, these applications are going viral. I think TikTok now, I just installed it again to test. It's over 1 billion installs or downloads. There's US, I read there's now currently over 100 million active users, and globally it's billions of people, right? So I think that we have to think that these social media platforms are going to be like a huge, tasty attack surface for malicious actors. We also have to take responsibility for our own personal data, right?
Mickey, talk to us about that, because you say you're a self-proclaimed global cybersecurity warrior. Be a warrior for us. If I can't leave it up to TikTok, what do I do to protect myself?
Thank you so much. I am a warrior, and I wish everyone would be, and we're asking more people to join the warrior bandwagon, so please do. But what you need to do, first of all, when you download from anyone, if you go to the App Store and you download social media applications, go read the details. What is their security policy and their privacy policy? What kind of data are they collecting on you? And then are you actively, looking at the permissions that you're granting to this application when you install it? If it's like click, test, touch, and I just gave like access to my phone, my camera, which, you're doing videos on TikTok and other applications, your camera, your microphone, your, location, all your contacts, I think your calendar. This is probably too much information to share. Then you also have to read the fine print. What are they saying they're doing with analytics that are being collected from you? And then who do you trust, right? Ultimately, you have to have a trust in the application. Any software can be exploited. They're never going to be perfect.
Mickey Boland, keep worrying and being a warrior.
Thank you.
Checkpoint Global Cybersecurity Architect, great to have some time with you. Meanwhile, let's head down to DC now, because we're going to talk much more about regulation of social media. The US Supreme Court in this instance has actually asked the Biden administration for input on Florida, on Texas laws that could sharply restrict the editorial discretion of social media platforms. Bloomberg's Greg Storr has the latest for us on basically censorship concerns on either side of the aisle. Greg, just talk us through what, in fact, the Supreme Court wants to hear from the administration.
Well, the Supreme Court wants to hear advice on should we take up these appeals. There are appeals from both sides. There are two cases, one involving Texas, one involving Florida. And basically, these are laws where the conservative governors and the conservative lawmakers of those states are saying, we're worried that social media companies are discriminating against conservatives, silencing conservative voices. So we're going to get in there and we're going to oversee their content management and impose a lot of new requirements on them. And the social media companies are saying that's a violation of our First Amendment rights.
Greg, looking at your reporting on the Bloomberg terminal, you have this Texas set of laws and the Florida set of laws. The Texas set seem to be the most sort of sweeping in terms of the actions they take against social media platforms. Tell us what they're based on. What do they require social media platforms to do?
Sure. The biggest provision in the Texas law would say that social media companies can't discriminate on the basis of viewpoint. Now, there are a few exceptions to that, but basically the idea is you can't take something down if it's coming from a conservative voice, if you wouldn't take something down coming from a liberal voice. And the social media companies say, hey, that might make it impossible for us to stop bullying, to stop spam, things like that. There are a number of other provisions involving disclosure and operational requirements as well. And the Florida law has a whole series of particular requirements that are in some cases the same, in some cases different. One of the ones that a federal appeals court struck down, or at least blocked, said that social media companies have to provide a thorough rationale every time they make some sort of content management decision.
And to that end, thus far, these laws have been sort of put on ice, shall we say, Greg? What's the next step? When do we hear ultimately from the Supreme Court?
Yeah, they are on ice, although a federal appeals court upheld the Texas law. So if the Supreme Court turns away that case, that law would go into effect. So right now we wait for the Biden administration. It will probably take several months to say, what it thinks the Supreme Court should do. And then possibly at the end of the court's term in June, but more likely, I would say, when they come back in October for the next term, the court will tell us whether it's going to take up these cases. Because of the widespread impact, because of the lower court divide over these issues, there's a pretty good chance the court will take it up, and then those will be huge cases for next term.
Greg Storr, a lot of work cut out, it would seem. We thank you for your time. And we'll continue this really important conversation. Later this week, we're going to be having none other than the FCC Commissioner, Brendan Carr, all about, of course, a focus on TikTok, a focus on social media here in the United States. That's Thursday.
Meanwhile, and coming up, how one startup managed to raise funds and secure a multi-billion-dollar valuation despite some down rounds, despite a tough market for startups over the last year. This is Bloomberg.
Welcome back to Bloomberg Technology. And we do so much in terms of public market coverage. But Ed, you're so smart on keeping us up to speed in the world of VC, venture capital startups. Get us up with what's happening this weekend.
Yeah, I think talking tech, we need to focus on what's happening in that part of the world because there are so many headlines, starting with Sequoia's regional arm in South and Southeast Asia. It's weighing up special audits of several of its investments in the region following allegations of financial irregularities. Some portfolio companies, including Zalingo and Go Mechanic. Over in Europe, Highland has raised a new €1 billion fund that aims to invest in private software and consumer internet companies in Europe. The firm going to focus on growth stage companies. Interesting that they've raised and closed that in this environment. And finally, fintech to HR outfit Deal says it's reached $295 million in annual recurring revenue by the end of 2022. But that was a jump of more than 400% from the end of 2021. The company also confirming its valuation has reached $12 billion US, Caro.
Fascinating that we're getting more focus on valuations, where they're being held at after the funding from last year. Let's talk about it with the co-founder, the CEO Alex Boisies. Alex, it's great to have you on from Deal. And I was on the website, everything you need to scale a global team. Just talk to us about the need for your services in an environment where, unfortunately, we're talking more about layoffs than scaling. How is your HR offering being, well, scaled in and of itself by other companies right now?
Of course. Well, first of all, Caroline, thank you so much for having me today. I'm very excited to be here. Deal started as a company that enables you to hire globally. So let's say tomorrow Bloomberg wants to hire someone in South Korea and they don't have the structure to do that just yet there. We enable you to hire someone as an employee there and give them the best benefits in a day. As the company kind of grew, we realized that we could do so much more, right? Expanding globally as a company is so key. And right now with the latest release, we basically become the full stack HR solution for you to really go global.
I'm looking at the global companies, Calvin Klein, Nike, they're all US based, but you've also got Forever 21, Shopify, a Canadian business. Where for you do you look to increase your own footprint in an economy that worldwide is slowing down right now?
Yeah, I mean, we've always been genuinely agnostic when it comes to regions, right? We want to help the best companies. Obviously, I think over 50% of our business comes from the United States. And then, we really have a global footprint and heads of countries in every country, actually. And really, as a global business, being European myself and my co-founder being Chinese, right, we really wanted to be able to cover most of the companies from the get-go. And that's what we've been able to do so far. So today you have US companies, but you have companies from all over the world and across all segments using Deal.
Alex, I want to go back to some of the numbers and the timeline of this. There were reports last May that you were raising funds. You closed that deal, I believe, over the summer. You've announced today a valuation of $12 billion. That is completely at odds with what Caroline and I are hearing every day on this show. Founders finding it hard to raise money, down rounds being more common than valuations growing. Was it a difficult environment for you?
I mean, for us, we closed that round in June. Really, the idea was not to raise money for the capital, but, we get to work with the team at Emerson, which is very impact-driven, right? And that's what we wanted to do. At Deal, the mission of the company is to help hundreds of millions of people get to work for the best companies in the world. So it was less about the money, but more about the people. And that's why the valuation was a bit easier to get to. And we've been really focused on the business itself. We announced that from September, we actually started being a bit positive. So we have a lot of money in the bank, and really, it was about getting to the right number for us and bringing the right people.
That's interesting. So you're saying essentially that, from very recently, you've started to be profitable. The other financial that you disclosed is that your annual average revenue growth essentially jumped 400% from the end of 21 to the end of last year. Are you worried now that when you see layoffs, freezing of expenditures in this environment, that you might see a delayed response from your customer base as well?
Well, not exactly, because the way we think about it is there's kind of two trends that are happening. The first one is more and more companies are cutting costs on software and they want to consolidate their HR infrastructure. And with this new product that we announced today, we'll help them by being the HR infrastructure and the full stack solution, not just global hiring, but really everything for them. The second part is, as a lot of businesses are starting to grow global, they realize that a lot of their costs in San Francisco, right, hiring engineers at $500K didn't make a lot of sense for their business and for their unit economics. So thinking about expanding their footprint and hiring people in location where it's a bit more affordable is definitely a trend we're seeing from most companies. And some of the largest ones are coming to us to understand what is the best way to do so.
What is a globally focused business right now, Alex? Because many would say the economies are splitting in two. And particularly as we see yet more geopolitical tension, whether it's Europe versus Russia, whether it's China versus the US. You said your co-founder is from China. How do you see companies wanting to scale their footprint at the moment? Are we being limited to certain spheres?
Not really. I think, she's American, but originally was born in China. And, the way we look at the world, whether it's her or myself, is that it's less about the geos. It's more about the talent, right? You just want, as a company, to be able to hire the best people wherever they are and bring them to your company, right? So I've not seen people think about regions apart when it comes to time zone, right? And how you want to build the culture of the company and how do you want to be versus, in office and not in office. But when it comes to those geos, we've seen maybe Russia get less hires at the moment, but in general, most people have been, very geo-agnostic when it comes to talent.
Alex, what about your own company and its health? Caroline and I are talking about tens of thousands of talented people in technology being laid off. Are you one of those companies that's currently hiring?
Yeah, I mean, for sure. We are 2,000 people across 100+ locations. We've always been as efficient as we could, and being EBITDA positive now enabled us to really be able to scale further. So, we have over, I think, $500+ million in the bank. We're generating money now. So we'll keep hiring to really bring the best HR solution to market and really help companies go global. So if you know great people, send them our way.
All right, Deal co-founder and CEO Alex Bouaziz, thank you so much for sharing the valuation news, but also giving us insight into what it's like to run a company right now. And for me, that's the takeaway. It's all well and good having the VCs on, the public market investors, the activists talking about what they want from a company. When you're at the helm, trying to raise money, trying to make decisions, it's interesting to see somebody so confident when there's a lot of negativity out there.
Well, I mean, a bootstrap business to begin with, a Y Combinator, well-known Silicon Valley-focused sort of startup culture. I'm interested, though, that he was talking already all the lexicon that investors, public investors and private investors want to hear. EBITDA positive, efficiencies, hiring across the world to ensure that they're basically making sure that they're efficient right now, that they're not overscaling, over-hiring, over-indulging, which is what so many of the big companies have been doing, basically, and having to rewind at the moment.
But to be fair, the other big theme that we've heard is that investors look for quality in times like these, where, okay, actually being profitable for many companies is a distant dream right now, could be an attractive investment.
But if you're scaling your revenue at 400%,
well, let's check in with them in a year's time, see how they're doing.
Meanwhile, coming up, we've got so much more to be checking in on right here in San Francisco, because testifying just down the road, Elon Musk, of course, is over in a court over that 2018 tweet saying that he wanted to take Tesla private. More on that next. This is Bloomberg. Now, with us both stood right here in San Francisco, let's do something very local for going viral, because the Tesla fraud trial is underway right here in this city. And look, Elon Musk continuing his testimony right on Monday, Ed, and he said, well, the Saudi Arabia Sovereign Wealth Fund, quote, unequivocally wanted to give him the money. But there was no email about it. He just said their word was as good as that. But of course, it's all in defense of some tweets he sent back in 2018.
That's part one of the defense. The other thing, and it extends from Friday, is that Elon Musk kind of rejected the idea that his tweets influenced Tesla's share price. And actually, he questioned how seriously anyone took his tweets. But having since bought Twitter, he's talked about Twitter being a very trustworthy, reliable source of news.
Yeah,
so what did we do?
citizen journalism. Yeah.
Well, we did what we always do on this show. We asked our audience to react to the quote that he put about whether or not his tweets should be trusted. He said, just because I tweet about something doesn't mean people believe it or will act accordingly. Do you agree?
Negative. 57% say that's insane. Of course, they felt that he puts out tweets that people believe, that act on. I mean, there has been criticism time and time again of the way in which he's perhaps talked up certain companies, certain crypto assets, goodness knows what, but people move and they make asset allocation decisions off what he tweets.
Yeah, and why he doesn't use a regulatory filing instead of a tweet. Tweet is his method of choice.
Yeah, many politicians would agree. Was it a tweet that almost broke the internet today as well? Is Eminem using, not Eminem the rapper, but M&M's what you eat?
Look at this. We'll bring it up on the screen in just a moment. M&M's is reconsidering its spokes candies. You see the former spokes candies along the bottom there. They have a new spokesperson.
Yeah, and apparently everyone can rally behind her, is kind of what they say. Maya Rudolph, they say, we are confident Ms. Rudolph will champion the power of fun to create a world where everyone feels they belong. Of course, many think this might be about the Super Bowl rather than...
We're 3 weeks out from the Super Bowl. Let's wait and see if this is real or not.
M&Ms are determined to break the internet. We didn't break the internet. We talked all about it, though. That does it for this edition of Bloomberg Technology. Tuesday, we've got so much more in terms of Interactive Advertising Bureau CEO David Cohen's going to be joining.
Don't forget, you've got to recap everything on the podcast. Spotify, this is Bloomberg.